The great debate in the market right now over where your money is likely to go. Our bull, NFJ's John Mowrey, argues the broadening of the rally is legit and can go even further. Our bear, Cantor's Johnston, who's made the case repeatedly right here that stocks cannot sustain the momentum and are sure to fall and fall a lot. Both here at Post 9, as you can see, to make their respective cases. Gentlemen, welcome back. Eric, I turn to you. This market has done incredibly well over the last month. Why aren't you finally bullish?
Well, the economy is slowing. One of the backbones of this economy has been the labor market. Certainly the labor market and the fiscal spending have really been the two things that have allowed it to stay so resilient. Fiscal spending is going to turn negative year over year very shortly. And, of course, the labor market, as we know, every data point is coming out. It is slowing. And if you look at labor costs for companies relative to sales growth, it has now gone wrong way, which means that when we look at our data, we think that corporates are now really going to start to cut those costs, and they're going to cut labor costs. So the economy is just starting to slow. If you look, a lot of people think that we are out of the woods because the Fed is done hiking. The last 3 Fed hike cycles, the recession has started 10 to 17 months after the last rate hike. The last rate hike was 4 months ago. So this is not unusual for the fact that we have not gone into recession yet.
It is unusual, though, how we came into the Fed hiking cycle, is it not? Right? I mean, the economy was at a strong point. There was so much stimulus in the system. Yes. This wasn't your just run-of-the-mill Fed starts hiking, so batten down the hatches cycle. And I think we've learned that over the last 18 months, despite many calls that the economy was already going to be in a recession because of the aggressive campaign that the Fed launched.
Yes, and I think that's why it's taken so much longer than many people, including myself, thought. But it doesn't change the fact that the trajectory of the economy is for it to slow. Now, there's questions around how much will it slow, but I think the data clearly shows that it's going to slow. And when you have slowing growth and lower inflation, earnings don't do well in that situation.
Well, I mean, slowing growth from, 5%. I mean, there are obviously, history is littered with periods of time where growth is good and inflation is not nearly what it is now or what it was, and stocks do just fine because earnings do just fine. What if we're just in a period of normalizing what economic growth is? I mean, what's the long-term trend? 2%?
Yes, the issue is that you're paying one of the highest multiples you've paid in the last 65 years. So the starting point around multiple is far too high. And then where we are in the economic cycle, right? We are not at the beginning of the economic cycle. The unemployment rate right now is 3.9%. It's been below 4% for 22 months. That's about the second longest ever. The longest was about 35 months, which should only be another year. So, and then if you look at nominal GDP growth since the last recession, it's already grown by 40%. And so the average growth coming out of a recession is about 55%. So we are late cycle. The multiple is one of the highest we've seen in 65 years. And you have an economy that's slowing, and you have earnings estimates that are too high. That's a bad combination.
Mr. Mowrey, you say what?
Well, I do agree that you are seeing stretched multiples, particularly in the larger cap tech space. So I would not argue with that. What I would pivot to is if you look down the cap scale, and we've seen this broadening out. I know you've been talking about it today on your show, Scott. We are seeing a lot of those areas that have been just blasted, and I think the recession has been priced in. For example, I'll give this statistic. We just pulled this up today. If you look at the number of stocks in the Russell 2000 value or the Russell Midcap value that are on pace to be down back-to-back calendar years, it's the highest since the GFC. And the second period that it was that high was in the 2000 bubble, coming out of the dot-com bubble. So there are stocks in the small cap arena that have absolutely been trashed. People have avoided these because they have higher debt balances typically. You also have a lot of financials. Those have been punished because of what happened back in March. But that's created the opportunity. The Fed is actually paying people to not take risk.